Account. The place where financial entries of a similar nature are recorded. For example, the sales account is where business income goes. The stationery account is where all pens, paper, staplers etc. go. A list of account names is called the chart of accounts. Accounts refer to the record of financial transactions for your business, whether income or expenses. You group different business transactions under different types of accounts, also known as journals. You can have a number of accounts, such as revenue and expense accounts. These accounts go into your general ledger, which is then used to create your financial statements, for example, your profit and loss statement. Accounting. Accounting is the process of recording, summarizing, analyzing, and reporting transactions made by businesses to government agencies. The process of sorting and entering financial data into a bookkeeping system. Also refers to the finalizing of end-of-year accounts, producing financial statements and calculating tax payable by a certified practicing accountant. Accounts receivable. Accounts receivable refers to the money that you haven't received yet from your customers for either your product or service. Think of unpaid invoices. Accounts receivable still count as money your business has earned since the customer will have to pay their bill. In the traditional accounting process, you would credit your accounts receivable with the amount owed by the customer. Once the customer paid, you would debit the amount and move to your cash accounts. Unpaid sales invoices, that is money owed to the business by customers, are grouped under accounts receivable, AR for short, and are found on the balance sheet as an asset. Once the customer pays their invoice, it is removed from this group. Accounts receivable is the balance of money owed to a business for goods or services delivered or carried out, but not yet paid for by customers. The amount of money owed by customers or clients to a business after the receipt or use of goods or services. This is money owed to your business by a customer for products and services. Accounts payable, AP. Unpaid supplier invoices and bills, that is money owed by the business to other businesses, are grouped under the accounts payable account, AP for short, and are found on the balance sheet as a liability. Once a bill is paid, it is removed from this group. Accounts payable is a short-term debt where a business owes money to its suppliers who have provided the business with services or goods on credit. When a company buys goods which need to be paid back quickly, it's known as accounts payable, basically money owed by a company to creditors. Accounts payable refers to the money that you currently owe vendors or suppliers. In other words, your short-term, unpaid bills for which you've already been charged. You record on your balance sheet the amount that you haven't paid yet to vendors and suppliers. Accounts payable is categorized as a liability because it's technically debt. The amount of money a company owes creditors, suppliers, for example, in return for goods or services they have delivered. Accounting equation. The double entry method of bookkeeping is based on the accounting equation, which is assets equals liabilities plus owner's equity, or the extended version. Assets plus expenses equals liabilities plus owner's equity plus revenue. Accounting period, the time period for which financial information is being tracked, usually done monthly. An accounting period is the time it takes to complete an accounting cycle. You record and report business transactions and turn them into financial statements. The length of time for an accounting period is normally 1 year, which means you gather all of your transactions and reconcile them with your bank statements for that year. With Neat, you can manage your accounts year-round. Come tax season, you have all the documents you need to file. It's the period in which financial information is tracked, most commonly monthly, quarterly, or yearly. Accounting cycle. The accounting cycle is a step-by-step financial process that starts with recording journal entries, posting to the general ledger, calculating trial balances, posting adjusting entries, and ends with generating financial statements. Accumulated depreciation. Accumulated depreciation is the total amount of depreciation expense of an asset that has been allocated since the asset was put into use. Assets. Items of value owned by a business. Assets are found on the balance sheet and include current assets like cash in the bank accounts, cash in the petty cash box, accounts receivable, and non-current assets like equipment, land and buildings, vehicles. An asset is any resource that has economic value that is thought to be a benefit in the future. It's something that is owned that can be sold in the future to make money. All items owned by a company which helps them run it. This includes money, equipment, buildings, vehicles etc. Current assets are those that will convert to cash within 1 year. Fixed assets are long-term and will likely benefit a company for over 1 year. Examples of fixed assets include land, major machinery, and real estate. Assets refer to the items, tangible or intangible, that your business owns and that could be turned into cash. These items might be property, vehicles, the cash you have, etc. Assets are included on your balance sheet. With traditional accounting, You have to add up and record how much you have in assets. Asset classes, a group of securities that behave similarly in the marketplace. The three main asset classes are equities or stocks, bonds or fixed income, and cash equivalents or money market instruments. Accountant. The person who sorts and enters financial data to a bookkeeping system. People often interchange bookkeeper and accountant to mean the same thing. Also refers to the person who does the annual financial statements and tax calculations. Accruals. Accruals refer to expenses that you've incurred but haven't paid yet. Accruals can also be sales that you've made, but the customer hasn't paid their invoice or bill. While accruals and accounts payable are accounting entries, accruals are entries that haven't been realized yet, aka you haven't received the bill or haven't received payment from your customer. If you use an accrual basis accounting method, you'll record accruals, both positive and negative, at the time of the sale. This is the opposite of cash basis accounting, which means you record revenue and expenses when you've made or received payment. Accrual accounting recognizes income and expenses when they are incurred, not when they are paid. For example, Mr. S buys a book in December, gets the bill and only pays the bill in January. In the accounts, the purchase is recorded and shown on the income statement in December at the date of the bill, not in January when it was paid. Accrual accounting is a financial accounting method where a company records revenue when goods or services are delivered or earned, and expenses as they are incurred. Accrual accounting uses the double-entry bookkeeping method. Accrual accounting is an accounting method that credits payments and debits expenses earned or incurred for a period of time. Amortization. Amortization is a method for calculating the value of and spreading an intangible asset's cost over the asset's useful life. Annual report. An annual report is a corporate document that is provided annually to shareholders that represent the financial status of the company and describes their business operations from the previous year. The annual report format typically includes detailed financial statements, such as balance sheets and income statements, alongside comprehensive analyses of the company's performance, strategic initiatives, and future outlook. Annuity. Annuities are contracts from insurance companies that promise to pay you a lump sum of income immediately or a series of payments in the future. Appreciation. Appreciation is the increase in the value of an asset over time. Adjusting journal entry. An adjusting journal entry is an entry that occurs in the company's general ledger at the end of an accounting period to account for unrecognized income or expenses for that period. For example, adjusting entries are used to account for transactions that started in one accounting period and ended in a later period, or that corrected a mistake from a previous accounting period. Arrears, money owed to you or that you owe, which is overdue and unpaid. Allowance for doubtful accounts. The allowance for doubtful accounts is an estimate of the percentage of accounts receivable that are expected not to be collected.